Welcome. We're here talking about the 2024 outlook for growth stocks. I'm Smart Brief Associate Director Jan van Valkenburg, and today I'm joined by Ian Sexsmith, who's a portfolio manager and senior research analyst with Parnassus Investments. Thanks for joining us, Ian.
Hi, Jan. Very nice to speak with you today.
Before we delve into the new year, because that's where we really want to focus, I'd like to pause and reflect. What drove markets in 2023? And is there still an upside in mid-cap growth stocks?
Yes, well, thank you for the question, Jan. And 2023 was certainly the story of the Magnificent Seven. These mega cap tech-enabled stocks have generated the vast majority of the market's gains this year, which is pretty incredible. And I don't know if we've ever seen this type of market concentration. And that is exactly why we should be looking for opportunities outside of these seven stocks. The Russell 1000 Growth Index, which is the largest stocks in the market, heavily weighted to those Magnificent Seven, that's up, much more than 30% this year, and it's within 5% from the all-time high that it hit in late 2021. The Russell Mid Cap Growth Index, meanwhile, which is the pond that my fund fishes in, that's up a little bit more than 15% this year, which is still pretty good, but it's down more than 20% from its November 2021 peak. So, mid-cap growth stocks have more room to rebound to get back to their prior ground. And historically, mid-cap growth stocks have traded at a premium multiple to large-cap growth stocks. Historically, that's been a 1-time to 2-time price to earnings multiple premium for mid-cap growth stocks versus their large-cap peers. But currently, mid-cap growth stocks are trading at a 1-time multiple discount. The reason they normally trade at a premium is just the law of large numbers. Earning a 10% annual return from a 1 trillion market cap company just means that the company has to generate $100 billion of incremental value per year at some point, Jan. That's just a lot of money. That's, in fact, more than the entire market caps of any of our mid-cap growth stocks. And we like mid-cap growth because these companies are large enough that they've established a financial model. They're managed by seasoned executives, and they have access to capital if they need it. That said, they're still small enough that they have significant runway left for growth. They have exposure to exciting secular themes, and they could even be takeout targets for these larger companies. Now, our mid-cap growth stocks, they generally aren't household names, so your friends may not have heard about some of our larger holdings like Guidewire and insurance software, or CoStar Group and real estate marketplaces, or Cintas in uniform cleaning. But once you spend the time and you dig a little deeper and you research the secular growth drivers and competitive advantages, these businesses are just as much fun to talk about as those Magnificent Seven. And quite frankly, by the time that all of your friends and everyone knows about these stocks, the outsized gains from the investment opportunity may have already been earned.
Well, like you said, mid-cap stocks have been doing well. Yet for next year, some experts are forecasting a decelerating economy. If that's true, is what you just said still true for mid-caps? How might this impact growth investing?
Yes, I've heard that too, Jan. It's certainly possible that economic growth could be weaker in 2024. So if growth slows, actually that increases the scarcity of companies that are still growing. And one principle of finance is that scarce things are worth more. If gold and platinum and precious gems were unlimited in supply, then the price of jewelry would be much lower than it is. And we would say that's similarly true for growth stocks. When economic growth is hot and all companies are growing, well, then growth is worth relatively less. But when economic growth slows, it becomes much more difficult for individual companies to grow. And as Warren Buffett once said, when the tide goes out, you see who has been swimming naked. So that's when companies with these secular tailwinds, unique advantages, and a culture of innovation really shine. And that is especially true for our brand of growth investing. We aren't looking for one-hit wonders or highly cyclical stocks that shoot up and then crash back down. Certainly not companies with profitless growth. we look for businesses with resilient revenue and durable growth. I would also say, if inflation continues to decelerate, that should be a positive for valuation multiples. After COVID, there were supply chain issues, and they've normalized now, thankfully. And the pent up consumer spending boom that came after that economic reopening, and then was boosted by government stimulus payments, that's fading now. And meanwhile, we have these long-term trends of high debt loads, which crowd out more productive capital investment. We have aging demographics, and we have tech innovation that causes lower prices. Those trends are still firmly entrenched. And even this year, one of the hottest topics is artificial intelligence. It's possible that causes a step change in productivity, which could, permanently lower inflation. And the same is true with driverless cars. In San Francisco, where I live, we now have fully autonomous taxis. The company is called Waymo. I even took one to the office this morning. This technology could dramatically lower the cost of transportation. And then, why is lower inflation good for valuation multiples? Well, inflation reduces the value in today's dollars of earnings that shareholders will receive out in the future. So growth stocks that trade at a higher multiple on their current earnings because their growth is higher, you're paying for that future growth. So when inflation is falling, it makes that future growth more valuable today. So growth stocks are more sensitive to inflation than value stocks. Therefore, they will benefit more from inflation cooling. Now, we aren't macroeconomic forecasters, but we are, very excited about how our fund could perform with a backdrop of slowing economic growth and decelerating inflation.
And so that brings me to, and you've pointed to it a couple of times now, what criteria do you look for when evaluating investment opportunities in specifically the mid-cap space?
Yes, thanks for the question, Jan. I mean, that's our secret sauce. So I'm happy to chat about that. So we look for businesses that are the best in the world at what they do. They provide a necessary product or service to their customers, and more importantly, they partner with their customers to drive innovation. These are businesses that are consistent market share gainers. They're often benefiting from secular trends. They have a culture of innovation. They've built and maintain a unique competitive advantage, and they're led by a seasoned management team that can drive operating leverage. The stocks, still need to trade at attractive valuations on their out year, free cash flow. So as long-term investors, we're more concerned with years 3, 4, and 5 than we are with next year's earnings. And we also do look at, stock-based compensation, which is a real cost of doing business, and financial leverage. Higher debt loads causes more volatility, and therefore, those stocks trade at lower valuations. So home run pitches for us, they happen when we're able to buy these best-in-class businesses when their business cycle is against them, or for whatever reason, investors just aren't seeing the long-term opportunity. Our best stock this year in 2023 was a company called Splunk. They built a broad data platform, and they were going through a business model transition from providing their software on premise. They were moving to the cloud. That caused a short-term drop in revenue growth and profitability due to different billing practices and contract terms. It was pretty clear to us that Splunk's transition was eventually going to result in meaningfully higher free cash flow. And Cisco, the big tech company, they eventually recognized that as well, and they bought the whole company for a big premium. So we were pleased with that. One of our best ideas right now is a company called CoStar Group. CoStar is a real estate data provider and marketplace owner. They operate, the go-to marketplaces for commercial leases and for apartment rentals. They're also building a new marketplace by expanding into the housing market with Homes.com. Their stock has trailed over the past, several years because the company is investing heavily to build this Homes.com brand. And this is the same management team that is following the same playbook that has worked so well in the past. And we would say that no one in the world is better at building real estate marketplaces than CoStar. They have a revenue model that is better for real estate agents, and they have a marketplace that has more data for consumers. So, we would say it's just simply a better product that's playing in a huge market. we think this could be a generational opportunity, and that's why CoStar is one of our top 3 holdings right now.
Well, thank you, Ian. And on behalf of SmartBrief and Parnassus Investments, thank you for watching.
Thanks, Jan.